In Forex trading, every successful decision starts with one key skill: market analysis. It's how traders understand what's happening, why it's happening, and where price might go next. If you want to trade like a professional, you need to master all three pillars of Forex market analysis: technical, fundamental, and sentiment analysis. Let's break them down one by one. First, technical analysis. This is the study of price charts. Technical traders believe that everything, economic data, market psychology, and even future expectations, is already reflected in price. So instead of analyzing news, they analyze patterns, trends, and key levels using tools like trend lines, moving averages, candlestick patterns, support and resistance zones, and indicators. Technical analysis helps traders identify where to enter and exit the market. For example, if EUR/USD is trending upward, forming higher highs and higher lows, a trader may use a moving average crossover or a breakout above resistance to confirm a buy setup. The goal here is to trade based on probability and structure, not emotion. But remember, technicals tell you what is happening, not why it's happening. That's where the second type comes in. Second, fundamental analysis. This focuses on the economic forces driving currency values. Currencies rise or fall based on the health of their respective economies. So traders study data like GDP, inflation, employment, consumer spending, and interest rates. For example, if the Federal Reserve signals that it's preparing to raise interest rates, the US dollar might strengthen because higher rates attract investors seeking better returns. On the other hand, weak inflation or poor jobs data could weaken a currency. Fundamentals are especially powerful for long-term traders who want to understand the direction of major trends, because strong economies attract money and weak ones lose it. Third, sentiment analysis. This one's about reading the mood of the market. Sometimes traders act more on emotions than on data. Sentiment analysis measures whether investors are feeling risk-on, confident in buying higher yield currencies, or risk-off, cautious and moving toward safe havens like the USD, JPY, or CHF. Tools like the Commitment of Traders, COT, report, market positioning data, or even news sentiment can show whether traders are overly bullish or bearish. And when sentiment becomes too one-sided, it often signals that a reversal is near. The secret to professional trading is combining these three forms of analysis into one strategy. Here's how. Use fundamental analysis to identify the long-term direction of a currency. Use technical analysis to time your entry and exit points. And use sentiment analysis to confirm whether the crowd agrees with your view or if it asks time to go against them. This three-step approach gives you a balanced perspective. You understand the story behind the move, the structure of the move, and the psychology driving the move.